In this week's video, we'll review the latest charts and several new market studies to help us answer the question, are new highs coming in stocks before year end? The first half of the video speaks to longer-term odds. The back end of the video will provide updates to inflection point charts. It's a daily chart of the volatility index, or the VIX, dated October 6, which is a Tuesday. It's intraday at 10:35 a.m. Eastern Time. At this point, and in the rearview mirror, we've been hearing a lot recently that we have a still elevated VIX. And while that is an accurate statement and somewhat concerning, we also have to keep in mind after the major low in 2009, this is the S&P 500 in the lower left-hand corner of your screen, we could have said the same thing in the second half of 2009. We have a still elevated VIX. We're basically sitting here, second half of 2009, the exact same area that we've been after the major low in 2020. As you can see, 2009, the VIX is up here. Present day, the VIX is up here. This is a weekly version of the VIX that we're looking at. And once again, while the elevated nature of the VIX is relevant, it's also relevant if we zoom in on the VIX as of Tuesday, October 6th, that we've got a series of lower highs and lower lows, similar to this period in here after the major low in 2009. This is the daily version of the VIX that we've been covering in recent videos. Even after the big drop in the S&P 500 on Tuesday, the S&P was down 47 points. The daily version of the VIX, still below this downward sloping blue trend line. Now we're looking at a monthly chart of the NASDAQ Composite Tape Index. It relies on three different kinds of breadth data for the NASDAQ. Orange box here, 2010, 2011, 2012 consolidation. Here, 2014, 2015, 2016 sideways consolidation. Present day, the consolidation starts in calendar year 2018 and continues into 2020. In each case, we get a monthly close above the upper Bollinger Band. You can see white space. You can see white space in here. And at the end of September of 2020, similar setup with white space above the upper Bollinger Band. In the two previous cases, with the similar setup here and the similar setup here, this rally lasted 2.5 years. This rally lasted almost 3 full years. Human nature being what it is, we like certainty. We'll have a tendency to take this look here and automatically assume and extrapolate that this is what we're going to see in the future, or we'll see something similar to this period here. That is a major violation of trade the chart in front of you. The chart that we have in front of us today tells us to be open to something like this and something like this, which could lead to something like this and this. You can see in the two previous cases, after this box here and here, the NASDAQ Composite Tape Index, the long-term version on a monthly chart, for the most part stays above the center line on the Bollinger Band, stays above the center line on the Bollinger Band. As we walk forward in 2020 and into 2021, we'll learn something either way. From a bullish perspective, if we look like this or this, and from a bearish perspective, probability-wise, if we see somewhat of a failed breakout look here, and then we move in this direction. This is the NYSE Advanced Decline Volume line. You take advancing volume, subtract declining volume. We're looking at it as a running total or on a cumulative basis. This is a monthly chart. This is calendar year 2008. This is the major low in 2009 here. You can see we move up and we get a monthly close above the center line on the Bollinger Band. Similar situation here. We drop below and then we get a monthly close above the center line here. in late 2011, early 2012. Similar setup here, weakness, and then we recapture the center line on a closing basis on the monthly chart. In each of these cases, after that monthly close above the center line, good things happened in the S&P 500 for a long period of time. In the present day, we do have in the history books nailed down a close above the center line. That's the good news. The bad news is we would prefer to see this indicator move to this side of the center line and stay there as it did here, here, and here for the most part. Dropping back below it doesn't really take out these historical comparisons, but we'd like to see some more strength here. Now we're looking at a weekly chart of the Dow Jones U.S. Mid-Cap Growth Index. Basically looking at mid-cap growth stocks. Calendar year 2000 on the left side of your screen, the present day. On the right side of your screen, this chart is dated Tuesday, October 6th. Only 2 previous times in the last 20 years, and we're looking at all the data we have we seen the weekly 6-period RSI make a move from this lower blue line and then hit the upper green line. It happened in 2003 after the major low in 2002. It happened in 2009 after the major low that took place in the S&P 500 in March of 2009, and we just had something similar happen again in 2020. You can see RSI only gets down to this level 1, 2, 3 times looking back 20 years. Therefore, it might be helpful to ask and answer. How did the S&P 500 perform walking forward from this point here and this point here, which is similar to this point here? The points in the past that are similar to this area and here in 2020 are May 9th of 2003 and September 11th of 2009. And in each case, looking out 1 month to 5 years, good things happened in the S&P 500 index. Similar situation here. We're looking at the same mid-cap growth index, same period, 2000 to 2020. This time, we're looking at weekly CCI. It's a 20-period look. Extremely rare to get down into this type of oversold territory. We did it here in Q4 of 08. We did it here, 2011 European financial crisis or debt crisis in here. We did it in 2016, here, early 2016, and once again near the low in 2020. In the present day, we've been able to get back to overbought territory recently, which would be similar to this point here, and this point here. How did the S&P 500 perform in the 3 previous cases? The answer, once again, is quite well. All 3 cases, the S&P 500 was higher 2 weeks later, 1 month later, 6 weeks later, 6 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. Worst case scenario, 3 years out, a gain of roughly 40%. In the other 2 cases, the gain in the S&P 500 was over 50%. This is a monthly chart of the American Association of Individual Investors, bulls minus bears. It's dated month-end September 30th of 2020. Extremely rare to see bulls minus bears on the monthly chart down in this area here. It's only happened 2 previous times in the last 26 years. Recently, the same monthly look was able to make it back to this green line here, similar to this point here, and similar to this point in here. Keeping in mind that we only have 3 instances looking back 26 years, might be helpful to know what happened after the 2 previous instances. In the S&P 500 index, good things happened for a long period of time. In both cases, the S&P 500 was higher 2 weeks to 6 months later, somewhat of a mixed bag 1 year later. In this case, there was a loss of less than 1%. In the other case, there was a gain of 46%. But in both cases, the market was significantly higher 2 years out, 3 years out, 4 years out, and 5 years out. It's a monthly chart of international growth stocks. We're looking at a mutual fund in this case, ticker symbol VWIGX. It's been approximately 7 months since the S&P 500 made the major low in March of this year. The 7-month rate of change. We're looking at all the data that we have going back to 1990. Only one previous time have we tagged this blue line. It was after the major low in 2009. Something similar just happened in 2020. In the previous case, good things happened in international growth stocks and in the U.S. stock market for several years. We've got a lot of information to cover in the second half of the video, thus we'll be moving quickly. Feel free to use the pause button on your video player. It's a daily chart of the volatility index that we covered in the Friday, September 18th video. The chart was dated September 17th. Basically said we hadn't seen anything yet in the VIX that was too alarming. And if we look at the same chart during the session on Friday, October 9th, those same comments still apply. Also covered this chart in a previous video. It was dated September 10th. We said previously this was the hot knife through butter look that we wanted to avoid. Like many charts we were looking at, this is your inflection point look on September 10th. This area right here is why we always say the longer a breakout fails, the more relevant it becomes, because it's common for markets to overshoot for short periods of time. Breakouts and failed breakouts typically are not clean binary events. Right now, this looks like a bullish breakout and a successful retest and a push higher. This chart is dated Friday, October 9th. We'll continue to look at charts that we covered in previous videos and then provide updated versions. This chart was dated September 17th. We said even if this area here didn't hold, there were several areas of potential support below. This was the version that we covered later, September 25th. We said it basically looked like a breakout from the June high, a successful retest, and now we were back down in that area and trying to make a stand. And earlier in this week on September 21st, we noted that the S&P 500 looked like it was retesting this area here, and we did get a bounce between this tweet and weekend. How does the exact same chart look today? Better, worse, or about the same? During the trading session on October 9th, the answer is better. Chart in front of us has improved, came back to that same area, and it looks like another successful retest of this June high area here. We've broken this downward sloping trend line, and since then, from a shorter term perspective, have been making a series of higher highs and higher lows. As always, the comments that we're making are based on the chart in front of us. September 10th, we said bonds versus stocks on Twitter. It was near a very, very important juncture from a short-term perspective. On September 23rd, Wednesday, we had somewhat of a concerning look. This looks like a bullish breakout attempt in favor of bonds against stocks. By the end of the week on September 25th, we were right back to that very indecisive keep an open mind about a wide range of outcomes looks. What can we learn from the same chart on October 9th relative to the net aggregate opinion of all market participants and their acceptance or aversion relative to risk? Relative to this look here from a bullish perspective for risk assets, this chart has improved, but it's probably fair to say we're still in somewhat of an indecisive inflection area here. But the longer-term trend favors stocks, and now the shorter-term trend looks like it may be rolling back over against bonds in favor of stocks. Those odds would improve further for stocks and against bonds if this ratio goes on to make a lower low, something that hasn't happened yet. Continuing with the indecisive chart theme, September 25th covered this chart previously. Home builders, one of the market leaders relative to TLT or bonds. This is a daily chart. Goes back to 2019 on the left side of your screen. This was the pre-COVID highs here in early 2020. On September 25th, we were somewhat consolidating underneath this level here. In terms of the chart in front of us on October 9th, this also speaks to improving bullish probabilities. The longer the chart can hold this look, the more meaningful it becomes. Right now, this chart printed a new high above the February 2020 high. QQQ NASDAQ 100 ETF relative to gold or GLD in the ETF world. Majorly indecisive look here on September 25th, dating all the way back to Q4 of 2018. Really not a lot of change on this chart here. From a longer-term perspective, gold still has leadership qualities trend-wise. From a shorter-term perspective, stocks have done better than gold since the March low. Triple Qs relative to TLT, so NASDAQ 100 relative to long-term treasury bonds. Here's that Q4 2018 spot where all of this begins. Came back on September 25th, came back and tagged this line and tried to bounce. In last week's video, we said, probably noteworthy, that we were consolidating above the blue lines here rather than below the blue lines. The chart shown on your screen, 1:28 a.m. Eastern Time on Friday, October 9th. At that point, QQQ was beating TLT by 5.55% for the week. At the close, that figure was 5.89%. This chart still looks good for QQQ. We'd feel a little better if we could go on and make a higher high. Probably not fair yet to say that we've moved away from indecisive territory, but this still looks like a bullish breakout and a successful retest at this point. Like every chart we cover, we're not making any assumptions about what this chart will look like in 1 week or 3 weeks, but we do know with a high degree of certainty what it looks like today. Covered this chart previously, equal weight tech. It was dated September 25th. It's a daily chart. This is somewhat of a concerning look here. Regardless of the fact that we have a longer-term uptrend, this was still an intermediate-term or short-term downtrend. You can see once again, this is an example of failed breakout looks. Can form, but the retest can actually end up being successful. In this case, the bearish breakdown where we gave up this June high was relatively short-lived, at least thus far. Downward sloping trend line, that's step one of a shorter-term trend change. Then we need to print a higher low relative to this low, and then a higher high. From a longer-term perspective, we didn't make any significant lower low here. These lows here are higher than these lows here in June. This high here is higher than this high here. So the longer-term look has really never been in jeopardy, and now even the shorter-term look has improved relative to the look down here. We'd feel better if this chart could go on and print a higher high above this level here. That will fall into the to-be-determined category. Similar themes here. September 25th. This looks like a failed bullish breakout and now a bearish breakdown. But as we noted using this September 25th chart, it looked like we were trying to make a stand at a logical level. Similar situation here. A relatively short-lived bearish breakdown look. And now this looks more like somewhat of a successful retest of this prior area of consolidation. Covered this chart. It was dated September 11th. This is stocks versus bonds. Very indecisive look here. At this point, it looked like a retest. Then it looked like a bearish breakdown relative to some of these levels here. But then we held at a logical level and rallied in this direction. This chart, October 9th at 11:47 a.m. Eastern Time. Similar concepts here. September 11th, growth stocks relative to long-term treasuries. Same chart on September 25th. It was up 2.41%. That was the good news on September 25th. The bad news was this is somewhat of a bearish breakdown look here relative to this breakout here. We're still holding well above the June high at this point. And at 11:51 a.m. on October 9th, intraday, we were printing a new high relative to this high here. Once again, there's nothing from a longer-term perspective here from the March 23rd low that says this uptrend is in serious doubt. Talked about this chart as well in the past. We said even if this breakout from the June high in the Dow doesn't hold, it's possible that this area down here could act as potential resistance. On September 25th, we also noted that area had the 200-day moving average right underneath it. So the area that we referenced previously is the pink box. Red is the flattish 200-day moving average. This is the look on September 25th. Thus far, the market was able to make a stand in the pink box and above the flattish 200-day moving average. It was also able to break the downward sloping trend line from the high on September 2nd. You may remember we covered this chart dated September 25th, and we said right now, relative to the June low, this A to B move, at this point we had retraced 61.8% of this A to B move, which told us this was a logical area to try to maintain some semblance of patience relative to the uptrend. The 61.8% level also coincided with the June high. How does the exact same chart look this week? Better, worse, or about the same? As you might imagine, quite a bit better from a shorter-term perspective. We held at the 61.8% retracement. We held above the June high. We could also put in a 200-day moving average in here. We held above the 200-day moving average, and we recaptured the highs from February of 2020. Still have some hurdles in here to cross. We have not cleared this high here. And then even if we went on hypothetically to make a new high, it's very, very easy for everyone to let their guard down in this area here as well. Basic rule of thumb. It's particularly never smart to let your guard down in the markets. We should always look at the markets with somewhat of a skeptical and risk-averse tone, especially when our capital is in harm's way. If things turn out better than expected, that's fine. Solution's very, very easy. You just leave it alone. Similar situation here. Gold looked like it came back near this 38.2% level from this A to B move, trying to make a stand above this upward sloping trend line. Nothing drastic here from a bullish perspective, but we did hold this level, and we are still above this level here. What once acted as resistance, what once acted as resistance may now act as support. This chart still has some work to do. We'd like to see a break of this downward sloping trend line and a series of higher highs and higher lows. That may happen, hasn't happened yet. Title of the September 25th video was, Are Stocks Ready to Resume Their Uptrend? On September 25th, the chart that we covered told us to keep an open mind about better than expected outcomes because we were trying to make a stand at a logical level here near one of these gaps that we were watching and a logical level here relative to the June high. We also noted that this chart, even if good things were going to happen, had work to do. This is still a short-term downtrend on September 25th. As you might imagine, the chart looks a lot better at the end of this week. This look here is Friday, October 9th at 2:07 p.m. Eastern Time. The market was up 29 points here. It closed up 30 points. So the closing look of this chart is basically identical. And while we had a scare earlier in the week with a big red day, the S&P 500 finished the week at 4 p.m. Eastern Time on October 9th, up 128 points. When you're down here, this concept applies. The longer below, the more relevant it becomes. We really only went below this gap here intraday. Hard to classify that as a long period of time. The same thing is true here. The longer we stay above this downward sloping trend line, and the longer we hold above this June high here and these gaps, the more meaningful it becomes from a bullish perspective. Both the longer-term charts and intermediate-term charts and shorter-term charts have been very, very helpful if we were able to trade the chart in front of us in recent weeks. That should be true as well in the subsequent weeks, and it really doesn't matter whether the market goes up, down, or sideways. But we all know the only way that any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.